where we had started to see some dollar strength emerge, one had to ask the question, what's changed? And it's nothing really, just the fact that we've got Eurozone issues more so at the forefront right now compared to the still plaguing economic situation over in the US, right?
Absolutely, and I said this before, I think we were basically in an ugly sisters debate as to whether the US or the Eurozone is the uglier of the two sisters, and right now it looks as though the Eurozone's on the back foot. We also had the ECB decision last week, which unfortunately, as much as the market had priced in a couple of interest rate hikes coming up, I think that the outlook for inflation was a little bit less hawkish than maybe the market was anticipating, as well as the fact that these persistent Greek issues just are not going away. There's this debate between the ECB and the finance ministers in Germany, this uncertainty around the secondary bailout, and obviously what their impact on the investors is going to be, which is all going to be negative. So for now, the Eurozone on the back foot. There has been a bit of risk off. Obviously, the market very concerned about data this week. There's a plethora of data. You've got Chinese data, you've got a lot of interest rate decisions coming out of emerging markets, and then you've got the US as well, which is expected to obviously be relatively slow on the growth side.
Let's take a closer look at the US data there, because we've got manufacturing activity reports and retail sales figures really at the forefront in terms of what's getting attention right now, and many looking at whether we're going to see further confirmation of what has been a negative trend that's arisen.
Look, I think there's two things to keep in mind, and we've been talking about this for a little while, but one is that inflation is in the system because of the food and oil prices that are coming through. But the concern is that the consumer is not coming online. You've got this underlying, if you take away food and energy, you ultimately left with very, very flat inflation curves across most developed world. So, you need that growth momentum, you need some form of sustainability, and we really are not seeing that. So you're not seeing consumers lending, you're seeing wealth effects being eroded, you're seeing continued pressure on unemployment. And these are the kind of things that continue to bode negatively with regards to the developed world.
Let's take a look then at implications for the local unit, Brigid. Just looking at what you're anticipating in terms of movement on the rand front.
The rand's been very well retained. It's traded within that 680, 665 range, which is quite phenomenal considering that we've seen such a massive sell-off on the euro. Euro's traded, it was at 147 a week ago, currently trading at 143, yet the rand hasn't really broken significantly above that 680, which is quite substantial in terms of the fact that the volatility levels on the rand are very well maintained. So you've seen the rand strengthen quite dramatically against the euro rand. Obviously, with the euro coming off and the rand remaining in that range against the dollar, it's opened up really attractive levels in terms of the euro rand for importers. But then on the flip side of that, you've seen a lot of dollars coming back into the market that has kept that rand supported at 680. So although we've seen a massive sell-off against the euro with regards to the dollar and this risk-off trade, it hasn't really impacted the rand that negatively if you think that rand has only traded up to 680.
Of course, as I said, for now we've got a lot of attention in terms of what's happening on the international market scene, and a lot of focus directed that way. There are economic data bits filtering through on the local front too as well, and many keeping eyes on that, saying that the benefits of a lower interest rate seem to have run their course, and we therefore expect to see a slowdown in the rate of decline in bad debts, for example, and that poses considerable risk to our own growth scenario from a local perspective as well.
Look, I think we're definitely going to have a knock-on from what's happening globally. Your developed nations are taking strain, so you're going to find that emerging markets are definitely going to remain on the back foot with regards to that. And I think that's where the concern comes in from your emerging market perspective, is that unfortunately this just seems to be an ongoing scenario that no matter what the liquidity levels are like and no matter how low interest rates are, consumers are not coming online in a bigger global sense. And that's unfortunately where we find ourselves. And that's creating a lot of turmoil in markets. It's creating a lot of unease. If you look at how currencies are trading historically, and all the lessons that we've learned economically are not necessarily applicable in these markets, and it really is about sentiment around where there's value, and the value changes quite quickly between regions, whether it's, like I said to you earlier, with regards to the Eurozone or the US. It really is an ugly sister parade, and unfortunately I think that's the scenario we're going to find ourselves in for the remainder of this year.